Hey everyone, got an exciting show for you today. It's Monday, which means we start our weekly journey with experts. And today we are bringing our Monday guest, Greg Dickerson, to the show. How you doing, Greg?
I am here, and I'm the expert of Monday. How you doing, Michael?
I'm doing very well, man.
I
Hey,
know
what?
more about Mondays than anybody else.
Well, you want to start the week off strong. You bring Greg on. He just kicks it off. So, the thing I want to talk about today is um, I want to look to the other side of this. Right, we're kind of in. I want to say the middle. That might be wishful thinking, right? Technically, maybe we're closer to the beginning. Maybe we're closer to the end. I don't know. But I believe, like everybody else does, this too shall pass. But I also know that there will be ramifications post-event. Um, and those will be economic-based things. And I think it's important to talk about because I think life certainly won't be the same after the event from an economic standpoint. And I think, just to put it out there, I think there's, we could talk about deflation. I think there's certainly something to be had there. I think there's inflation. I think that's a worthwhile discussion. I think taxes are going to change in a significant way. So, which one of those topics, or a fourth one that I'm not thinking of, gets your attention that we can kind of bat around?
um, you know, uh, I guess all those sound good, and I think the biggest thing is there's great news and there's bad news in all of this, right? So,
Mm-hmm.
we have some hope now because they are opening back up in some areas. People are going to get back to work in some areas, but until we have a vaccine and a treatment, this ain't over.
Yeah.
And by opening back up, we could have a big flare up again, in a couple, 2, 3 weeks in the
Yeah.
fall. So this ain't going nowhere anytime soon. You could be potentially facing a shutdown again. So
Mm-hmm.
my number one thing for everybody to keep in mind is keep building your reserves, keep playing defense, do not go on offense. This is not over, and it's not going to end anytime soon economically.
Mm-hmm.
Okay. Now, from a health situation, I'm no expert. I don't know. All I know is what they're saying.
Mm-hmm.
And we do know the reality of the situation. You need a vaccine, you need a treatment,
Mm-hmm.
but once you start letting everybody out and all we've done, and the whole purpose of what we've done is slow this thing down so that our health system can respond and we have time to develop, testing, treatments, and vaccines.
Mm-hmm.
That's what we've done. So don't forget that. That's all we've done. So we have to now get through this reopening and what that's going to look like. And you're already seeing the way that's going to change in terms of, restaurants only being able to allow so many people back. Hair salons, the way they have to operate, it's going to be more expensive. It's going to be slower. It's going to be less people, but people are back to work. They are making money. We've got to do that. So, that makes sense in the areas that you can do that safely and efficiently. But anybody who says it's a light switch, it's a V-shaped recovery, I don't know anybody that's saying V-shaped anymore. There might be one or two more people that say we're going to rebound quickly. They're either going to be in the government or
Mm-hmm.
they're going to be on Wall Street trying to sell you something.
Yeah.
So the only people talking about massive recovery and all that, that's where it's coming from. So you got to understand the reality of the situation and your own behavior. Okay. I can tell you, for me, for one, I'm not going to go out to a nice restaurant and sit down inside a restaurant where I'm being served, with somebody in a mask and gloves. To me, that's just,
Yeah.
I'll do takeout, but I'm
Yeah.
not going to eat in.
Yeah.
It's just not enjoyable, and whatever. I'll give them $20 and do takeout instead
Yeah.
of sitting there.
I agree.
That's number one. Movie theater. I used to go to the movies every weekend, if not twice a weekend. I'm not going to do that because I don't want to sit there in a mask and then open that and eat popcorn and you know. So then the airline industries, you talked about oil and all that in terms of demand. Are you going to even be able to travel internationally? What's it going to look like traveling recreationally across the country? What are the vacations going to look like? I've got interest in a resort area that's a summer vacation destination. The Outer Banks of North Carolina. I have family there, and I do investments there. What's that going to look like this summer? Are people going to still book their vacation beach homes and
Mm-hmm.
still travel and do all that? So there's a lot of uncertainty out there. It's going to take a while. And, I initially thought it'd be 12 to 18 months to get back to 75 to 80% of where we were,
Mm-hmm.
from GDP, employment, economy, things like that. It might be 2 years to 3 years, I think now.
Yeah. Yeah. I'm starting to get in that in line with you there. I was originally hoping it was going to be kind of 18 months was my hope, right? Basically get through 20, right? Survive 20 get to the end of 21 and like, okay, we're back to normal. We put this behind us.
Mm-hmm.
I just don't see it. I think there are too many things that are broken that just need to have price resets, right?
Yeah.
For example, you brought out of restaurants and hairdressers. I believe most of them need to renegotiate their lease, right? They negotiated a lease at, pick a restaurant, 20 tables.
Mm-hmm.
Now they can only have 8 because they have to be 6 feet apart or whatever. So, I mean, either they renegotiate the lease or price of dinner goes up doubles. I mean, there's just all these things. Just life is going to be different on the other side.
Well, and here's a gem for everybody who's listening. So co-leasing. So look up co-leasing. If you have a lease, if you have a building, look up the co-leasing clause in your lease. So that means if a certain percentage of the center goes dark, or if you lose a major anchor, you can renegotiate your lease and or cancel it with no penalty. Nice. So yeah, if you're in a shopping mall, retail strip center, power center, whatever it is, grocery anchored center, and that big box goes out of business, or 80%, 20% of the spaces go dark. Generally, in your lease, you can renegotiate and or walk from your lease. So, nice. Take a look at that. But yeah, I think there's going to be a lot of workouts. There's going to be a lot of that going on. For those of you that are worried about your loan covenants being violated by DCR, ratios and things like that, don't worry about that. There is no lender scrubbing their portfolio, looking at anybody's loan who is paying. Yeah. So as long as you're paying, they're not going to come after you, and they're not going to start digging into your lease and digging into your covenants and trying to, call you up and say, hey, is your balance sheet still the same as it was when you got this loan? That's only if you're not making payments and you go for extended forbearance. Now, commercial and investment properties, if you ask for forbearance, some lenders might, ask you to prove hardship, and they're going to say, hey, where's this balance sheet that you had when you bought the property? But, for residential, for residential and other stuff, it might be an easy conversation. So unfortunately, I think it's going to take longer than what everybody thinks. We have to get back to work. You have to open up where you can, how you can. But I think inevitably we're just going to flare up again. I mean, it has to. I mean, there's a lot of people that this has not affected yet and haven't been exposed. So, just by where we've seen and what we've seen, and we haven't taken the measures these other countries have taken, in terms of locking down. So you have to expect this to rebound and potential shutdown again.
Yeah, let's put some numbers on this conversation, because there are some headline numbers that everybody's been watching, and I'll just pick on unemployment for an example, right? We went into this crisis at 3.5%, right? 3.5, 3.6, whatever it was. I've had some economists do rough math on our 22 million or 26 million that are new unemployed. They're expecting the April number to be 22%. They also expect May to increase. It could flare up to 30%. So let's just say it's 30% for easy math, right? Let's just say you go from 4 at the bottom to 30 at the peak. Let's kind of walk it through a year, 2 years, 3 years, because I think it's important to see how that falls apart. Because, let's say we open up, most of the country here in the middle of May or June. If unemployment's 30%, it probably only goes back to 19, 18%. Because again, it's not everyone. You don't need everyone.
Yeah, it's not everyone. And then a good percentage of them are going to make more money not going back to work.
That's so true.
So they're that kind of there's some pushback there. I've seen stories and interviews of, people that applied for the payroll protection, received it, told their employees, hey, I can bring you back to work. And they were actually mad because they were going to make less money going back to work than they would just, staying home. So
I
got that whole side of the equation.
I don't know what percentage of my tenants are, but I've heard some of my tenants actually say that. They make more money sitting on the couch now. First off, know that that's a short-term thing. I think it's currently 4 months. It might be 6, that extra $600 kicker. I don't know. I don't want to get into that debate. It's stay away. But anyway,
to each his own.
To each his own.
You gotta do. But I'm all, look, go out, be productive, go to work. Don't sit at home and collect, because it's not good for you mentally. Just get back into the economy. The problem is, when people do go back, how long are they going to be able to stay? Is a business going to be able to actually get through this, sustain? make it to the other side, because we're not going to see spending come back.
No.
Number one, everybody's got to replace the reserves that they went through before they can start that discretionary spending again.
Great point.
And putting money back in. So, I mean, if you've gone for your savings, you're not going to go out and start spending money. You got to build your savings back up, because like I'm telling you, you need to do that, because this could happen again. Maybe it'll be more isolated, these flare-ups, and you just close little pockets here and there. It may not be a national thing, but it's going to be slow. So the unemployment is going to be interesting to watch, because not everybody is going to be able to be put back to work, although everybody was stressed for help to begin with. So there probably will be jobs for a lot of people in some areas, but then other areas where there are no jobs, and the Purdue plant shut down and there's 800 people out of work.
Yeah.
I don't know that there's anywhere for them to go, or any other options.
Yeah, I think unemployment's going to be with us for a while. I don't see us getting to single digit unemployment.
Yeah.
Probably until the summer. Oh man, no, actually I'm going to say early 22, like January, February of 22. So all of 20, all of 21 before we see 9.9% unemployment. Am I being too pessimistic?
Yeah, who knows? It's hard to say, but I think you're right on track, because this year is almost over for all intents and purposes in terms of restarting. I mean, we're already in the second quarter. It's end of April. I mean, we're going to be in December before you know it.
Yeah.
So that's just getting things back going again. So then now, if we can sustain that momentum going into 2021, now you're on the ramp up. So yeah, I think you're right in there. I think you're not going to see single digits again until we get into 2022.
Yeah, me too. So again, as Greg said, right out of the box, play defense, don't get aggressive. A lot of investors are communicating with me about, hey, is it time to go all in? Is it time to go all? I mean, God, you want a 5% discount? I mean, come on, people, it's not that time just yet. So
yeah.
Realize what.
So the interesting thing will be, on that note, April did pretty well. Most people were on par with collections. There wasn't a lot of issues. I don't know how May's going to look. I would expect May to be a little bit worse, and maybe even June. So we'll see. If May is a good collection month and June is a good collection month, I don't think you're going to see a big impact in the real estate market. A lot of people are thinking that everything's changed, a whole new world. It really hasn't yet. I mean, there are still Melissa Johnson, right? Formally, I guess they're no longer, but anyway, she just put a house on the market that she flipped the other day, had 15 offers the first day.
Wow.
So I mean, there's still markets that are still very hot, very active. My market is still really hot, really active. Stuff selling in days. On the commercial multifamily front, the only thing that's changed in that world is debt requirements and reserve requirements.
Lending,
The demand side has not slowed down.
Wow.
And we're still seeing cap rate compression. We're still seeing aggressive competition for assets. Some people are asking for discounts to compensate, and sellers are going, look, I'll just wait.
Yeah,
as soon as this changes, which it will, then it's going to be right back to business as usual, because interest rates are so cheap, which leads into going into the inflationary discussion we were having, or before we started recording. So the real estate market has not changed,
not at all,
across the country.
Yeah.
Maybe some pockets here or there, but it's not time yet. There are no deals or discounts out there. Now, there might be less buyers in some markets because the financing is a little trickier, things like that. But there's still a lot of demand out there, and there's not much inventory. So that's
so that you just hit the key, at least for residential, is let's say demand went down 50%. Because again, we did wash out a lot of people when lending changed, right? The whole 90% of purchase, 100% of repair loans that were coming via hedge funds. That market dried up, so that most of the flippers are toast, right? So let's just say demand's down 50%, but supply is down 80%.
Yeah.
So you have this artificial window where there are less buyers, but there's a hell of a lot less sellers. So it's very competitive.
Which is good.
Yeah, but there are cracks. What people aren't seeing, at least I can only speak to one market because I only look at one market every day. The MLS is getting very saturated with new construction. Right. New construction in my market was probably 15% of listings in February, because most sold via open houses, right? They had the big flagpoles, come see me. That's how they sold them. They never put them in the MLS. in the last 2 weeks, over 50% of new listings have been new construction because
Yeah.
they shut them down. So that's going to be a problem eventually, because we're seeing below the median just sharks everywhere competing, but all this new construction is just aging out above the median. So there's pain to be had in the future, I think.
It'll be interesting to watch what that is. Are they to be built? Are they under construction?
Oh,
or
these
are
ones
they
are all
ready?
new. These are done.
They're done, complete, ready to
done,
go?
complete. They were putting them on the market for the spring selling season. That didn't happen.
Yeah. So the key will be, how long does it take to work through that? What does the days on market look like? That'll be an interesting metric to follow.
I will be doing that. It's happened in the last 20 days. I mean, every day there's more, and they're all 350 and above in a market that's 250. So it's like, what's going on? So let's talk about those three topics: deflation, inflation, and taxes. Let's do deflation first, because I think that is going to be the first thing. And I think it's going to shock most people, because we don't talk about America, US, and talk about deflation a lot, right? It's often that thing, the boogeyman out there that the Fed is scared of and all of these things, but it really hasn't happened all that often in history. And I can't remember one in my investing career. But I think it's going to happen. I think 2020, when we look back on it, is going to be the year that we saw real deflation in the second half of the year. What do you think? I'm being silly, or do you think that's a real possibility?
It's hard to say. All we know is because this is unprecedented in terms of the monetary policy that we're seeing right now, stimulus, everything that's going on, interest rates, where they are. Oil hitting, negative numbers, and Wall Street is still going
35.
nuts. Yeah. So, who knows? And all we know is what happened 2009 on. So we probably pumped half into the economy that we're seeing now back in 2009. But again, it doesn't go into the pockets of the everyday American.
Yeah.
That's where you're going to see inflation, deflation, unless it hits your pocket, my pocket, and everybody else's pocket. That's when you're going to see the real effects. The only thing we're seeing right now is inflation and or potential deflation in assets. That's where it's going to be. It's going to be in stocks. It's going to be in bonds. It's going to be in treasuries. It's going to be, potentially in real estate. But we didn't see real estate. We haven't really seen it affected in the way it should have been in the last 10 years based on interest rates. We've seen it appropriately inflate in relation to real estate. Your payments kind of stayed the same for a bigger property, but you had to qualify. So it wasn't like 2009.
Right.
So, asset inflation was there, but it's all relative, right? Because the interest rates are half of where they were. So the price went up a little bit, but it hasn't gone up exponentially in every market where everybody's just outbidding. It's only in certain areas. And there still is price point pushback. You just referenced it in your market, the stuff coming to market at 350, people aren't jumping all over it.
Nope.
So there has been price pushback, in certain areas. So, I don't even know how to answer that. I mean,
so let's talk about CPI, right? So again, that's what I was referring to as deflation, right? So consumer price index. Asset price, Fed pumping trillions of dollars. Asset price, they're doing everything they can. Frankly, I think the wealthy have been helped out the most so far, because they've kept the stock market, in my opinion, artificially high. But when I'm talking about the deflation, I'm referring to the CPI, right? So that's the basket of goods, right? So food, gas, travel, healthcare, rent, the things that most people spend money on, right? So if you just tick down the list, I looked at this the other day, it's been a week, so I'll be off, but gas, it's cheaper, going to be cheaper through the year, right?
But not exponentially where it should be right now based on oil. Right?
True. No, that's true. But again, from the person that's going to the gas pump, it's cheaper. Clothing, I think it's going to be cheaper. We have so much inventory of ready-made goods, at least short term, it's going to be cheaper. Now, long term, it'll probably go up, because all these places that make clothes like Bangladesh and all these other places, and they're shut down, right? So, I mean, there will be supply chain impact, but short term clothing is down. Rent ain't going up. Rent could go down, right? But it ain't going up, right? So when you just start ticking down what makes up the basket of goods, I just don't see how we have inflation. And the only thing I can think of is, we might actually print a deflationary number in the CPI in Q2 or Q3. It just shocks me to think about.
Yeah, that's an interesting thought, because the only thing we're buying, like you said, really, are groceries and things like that. and you are seeing some deals and some discounts on certain things, but I think it's, like you said, it's going to be short lived until we get back going again.
For sure.
Oil is just an anomaly because nobody's moving anywhere.
Yeah.
Airlines, all that. So as soon as you get going and all that, that'll start, to ease that pressure up a little bit. But we're not seeing it in food,
No,
and
true.
and what's happening there is the food supply chain is struggling because
it's broken.
plants are shutting down.
Yeah, plants
and
are like
people
meat.
have been buying so much,
Yeah. Well, people have been buying, and also there. I mean, I just read a terrifying article about the meat industry. They're shutting down plants that produce it, and we're gonna, we could see a real impact of meat not being at the grocery stores, and a lot of that's because I think I read an article like 40 to 50% of the meat production goes to restaurants.
Yeah.
Right. And that's not there, and it's just screwing with the whole process. So pretty scary. So let's talk about inflation then. Everybody's talking about, hey, America's going the way of Zimbabwe. They're going the way of Germany back in World War, whatever it was, II or whatever. They're just going to print money, and hyperinflation's right around the corner. I think that's hyperbole. I don't see hyperinflation. It's pretty hard to have. I would hope it's hard to have hyperinflation in the reserve currency of the world. But inflation, I mean, I could see inflation being the topic of the day in 2021. We're going to start coming back to work, where we will have worked through the supply glut, which I think is going to make up 2020. Then we're going to start to see that, wow, there's not as much finished goods that we need, because by then the consumer will be spending again, right? They've had 6 months to get used to it.
Yeah.
And then we're going to realize, shoot, we're not making as much stuff as we used to. And then inflation is an outcome, I think. It's certainly an asset.
Assets, obviously, because there's so much free money out there.
Yep.
The Fed's buying everything. They're loaning everything.
Yep.
So, when it comes to stocks, bonds, treasuries, gold, even oil, when it comes back, it's all a game.
It's all a game.
And it's a very dangerous game because there's a huge disconnect between the markets and what's going on.
Main Street really and Wall Street is broken.
Yeah. It's not even close to reality. It's these hedge funds and investment banks. They all reported where they make their money on their trading desk.
Yeah.
Because they're being given money by the Fed to go play with.
Yeah.
And it's all artificially propped up, which it has been for the last 10 years. So, but the interesting thing about what you're talking about is, at the end of the day, what's the real effect as people get back to work? So one thing you said were rents. All right. So we're seeing rent control becoming mainstream conversation.
Absolutely.
Because of this. So not only rent control, but eviction changes,
Yep.
Things like that. So from a property ownership, you got to really pay attention to that. And like you said, I don't know if rents, I don't know if they can be pulled back, but if they can keep you from raising rents and control that, you're going to have no choice because the market's going to become more competitive.
Yeah.
So there's going to be a lot of pro formas that aren't going to get met, that we're planning on 3% rent growth, which is about a normal amount to expect. The problem is people's incomes off of this are not going to exponentially increase to be able to afford rent increases, right? Most people are just grateful to get back to work. They're not going to be given a bunch of raises, a bunch of money, because the companies now have to reboot, except for the hourly workers. There's all this talk now about $15 an hour minimum wage. May already be in your area. In ours, it's not. Most people are making about 10, so that's not a huge deal, but that is going to be a huge deal for the operator.
Oh, yeah,
so if now that retail store, that hair salon, that restaurant has to pay $15 minimum wage, that's going to increase the prices of those goods and services. So I think there's going to be pockets where you're going to see some inflation. I think there's going to be some pockets, like you said, a lot of retailers going out of business, so clothing will be on sale. So there's going to be some deflation in some things, but I think it's all temporary. It's all short-lived. I think the long-term effects are going to be minimum wage increase and rent controls that are going to exponentially affect a big segment of the market moving forward in terms of, inflationary.
Yeah. And again, just to round out these two topics, I think deflationary is a very short-term kind of 2-quarter impact of, hey, you shut the consumer down, you shut 30% down, but there's still a whole bunch of stuff in the system, in the pipeline that just needs to be worked off. And then I think inflation takes hold and grows. And we certainly have, 2, 3, 4% inflation, especially if you start adding in, you take minimum wage up 50% in much of the country. More money in the system just makes stuff more expensive as time goes by. But then there's the big one, right? Not many people are talking about it, and I wanted to talk about it with you, is I believe we are going to see lots of tax changes, both at the federal and state level, because we have to pay for this somehow. And one of the things that people don't realize is, I mean, I just saw today, right? New Jersey came out and said, we have Armageddon. We have lost all revenue and we are spending money on the service like we've never done before. And that's not a mismatch that will last very long. New York has already done it. California has already done it. There are huge states that are running massive deficits that when this is passed, they will have to raise income. And what that means, folks, is when a state raises income, that means taxes. So I'm scared for all those things that people are counting on, like the $250K tax-free for selling your primary residence if you live there 2 years, gone. There's just a lot, and we have Prop 13 in California, which everybody's held on to for years. It keeps taxes low if you've lived there forever, gone. I mean, there's just some nasty changes coming, I think. And I was wondering what you thought.
Yeah, I think so. And I think that whole municipal side of the equation, that bomb hasn't dropped yet. There's a lot of cities, towns, counties, state governments that are struggling, just like every other business. And, you know, their only source of revenue to pay back the federal government and all that, and you know, to support themselves is to raise taxes. So, you know, you're going to see real estate taxes, personal property taxes, you know, all that kind of stuff. And I think most people are probably going to be, the good thing would be if they said, hey, it's temporary, we got to get this stuff paid back.
Right? Temporary taxes, that's funny. That's not going to happen. They'll tell us it's temporary, but it ain't going to happen.
That's the problem. So it always goes up and never cuts back, right? Exactly. So all they have to really do is take a look at their budget and say, look, if we cut all this junk out, we'll be totally fine. Everything's paid for. But, you know, that's not going to happen, right?
Yeah,
unless there's,
that's great in theory.
Overhaul. You know, so there's, you know, this tax conversation. I mean, you know, there's a number of ways to resolve that. But yes, I think on the backside of this, okay, America, we bailed you out. Yeah. Now we got to pay this back. You're going to have to, you know, you're going to have to pony up, and it's going to be, yeah, I think that's going to be a conversation that's going to be had once we get through this.
Oh no, it's on the other side. It's on the no question. It's not the time for it. It's on the other. But again, I think this will hit everybody. I think it'll hit the wealthy as well, right? For example, that whole carried interest thing that hedge funds have been using for years to delay taxes, gone. I mean, they are going to slash. Taxes
That's going to be the first
up.
Group they're going to go after. They're going because Wall Street's raking it in right now.
Yeah.
So that's the first group that they're going to go after is big business, Wall Street. You know, a lot of those things. You know, if they you know repatriated investment from offshore, that could help stimulate. You know, so there's a number of things they could do. You know, maybe just reduce one-time repatriation tax. Yeah. You know, that'll bring in trillions of dollars that's offshore that could help offset some of this. So there's some things they can do. You know, there, but yeah, I think that they're not going to say it now. That's the last thing anybody wants to hear right now.
Yeah, they're not going to talk about taxes before November. That's for sure. Nobody's going to be that silly. Oh, that's funny.
And it's really funny because if you think about the stimulus check, I don't even know who's gotten one. I mean, how many people have actually received that?
I haven't. Yeah, I don't get one. I don't think.
I don't either. But you know, I think like half of the population that is qualified for it has received it. And I mean, when did they start talking about that?
Yeah, it's
you know. So at the end of the day, what's that really going to do? You know, and if you're supposed to file and get a refund, when are you going to get that back? So it's just kind of.
I'm still waiting on my refund. I filed. I haven't got my refund yet.
Yeah. So it's really interesting. And then the SBA will be interesting to watch today with the new PPP program. You know, I put a little video out this morning, just letting everybody know. Look, go to the site now. It's 8:00. It opens at 10:30. You know, get the application, fill it out, get your documents in order. The problem is a lot of people don't do that stuff, you know, and they're trickling their documents in, and they're the ones that are going to get left behind.
Since you put that video out, I haven't looked at it yet, sorry. But if you had your PPP loan from the previous tranche, do you have to redo it again?
I don't think so.
Because there's a lot of people that were in already.
I mean, all I can say is go to the SBA website and see what they recommend. But I think what they said was they're going to pick the ball up with the applications that were already in.
Yep.
Process those first.
Yeah, that's what I heard too. Yeah.
Yeah, I mean that's what it says on their website. Yeah. So what actually happens? You know, I don't know.
Yeah, that's one of the things over the weekend I was very disappointed in is all the public companies who have the debt market they could go to, getting small business loans when you're a publicly traded company. I thought that was certainly by the letter of the law, okay, but
Yeah.
was not the intention of the program. And a lot of them are giving it back, but not everyone, at least not yet.
Yeah.
So that was interesting. So I want to ask you a question about interest rates. We talked about unemployment going from, starting at 30, not getting to single digits, maybe until early 2022. Let's talk about interest rates at the Fed level. I don't see the Fed raising the federal funds rate for 5 to 8 years.
Yeah. Ever.
Maybe a decade. Yeah.
Ever. Because if they do, that is economic Armageddon. The only thing holding this whole thing together from just completely coming apart is zero interest rates and the Fed buying anything you want to throw at them.
Yeah.
Make a document and put a number on it and we'll buy it.
Yes.
So junk bonds, when the Fed is buying junk bonds, what does that really say about where the economy is? And I think that's what a lot of people realize is that without what they're doing, we're in big trouble. So there is no reason or no way that can happen until we are fully back open. We're back into single digits, low single digit unemployment. We're back to 5%, growth, and the economy's firing on all cylinders. Then maybe you can talk about inching up a little bit again like we were before.
Right.
But you saw what happened even when the economy was supposedly healthy.
Yeah.
And they started inching up.
18,
it started tanking.
It did.
Yeah, it started. It has an effect. So people are conditioned now.
Yeah. So let me ask you this. Let's say it's a decade. Let's say it's 2030. Do you think the federal fund rates is still kind of where it is today? A decade.
Well, let's go back 10 years. Where was it? 2009.
That's a good question. I think,
2010.
You're right.
Yeah. So it crept up and then down. You know what I mean? So we haven't crossed a 5% threshold since 2008. That's when they tanked the economy. They went over 5%. Everything imploded, and they learned their lesson there that they can't. They just can't. Yeah. And there's too much, that will destroy. So if you look at the last 10 years, I think that's what we can expect. Now, that's assuming things start to reopen in the next couple of years like we're talking about. I mean, there's no telling what the real, I mean, if we have a whole nother shutdown and this happens all again in the fall, all bets are off. But totally assuming we're on our way up, to that recovery that kind of looks, I don't even know what you would call that. It's not a swoosh. It's not a,
I don't know. It's a badly formed L. Oh man, this has been a lot of fun. Deflation, inflation, tax changes, interest rates, unemployment. A lot of fun conversation. Any closing thoughts?
Inverted parabola.
There you go. Any closing thoughts as we wrap this conversation up?
Yeah. So be encouraged. Okay. So there is light at the end of the tunnel. If you can work, get to work. If your business is in jeopardy and you're potentially losing your business, you're better off to cut it now and cut it sooner than to try to wait it out later and get deeper and deeper and deeper. And then, reboot that and try to pivot and do something else. So you can always restart later. Okay. So it's better to cut your losses and then do something in the interim and restart later. There's a lot of people looking for help right now remote. Okay. There's a lot of people looking for people to make phone calls, for sales in the real estate game, acquisitions, dispositions, lead managers. There's a lot of remote work. So if you're out of work and you're looking for something to do, there's a lot of people looking for that. There's Upwork, there's sites like that looking for contractors to do things remote. So there are things you can do to earn money right now in the interim while you're kind of in transition, as things open up. And then just be careful, be smart, keep building your reserves, plan for this to happen again in the fall, or a little bit of a stumble as we start getting closer to the holidays, and just be smart and be ready. And just stay positive, encourage, keep moving forward, keep developing yourself, keep those plans, don't give up, don't quit. Now there's a difference between closing the doors on something that just there is no upside and quitting. I'm not saying that's a quit situation. I'm just saying there may be a better time to revisit it later.
Yeah, I want to echo that point. I think there's a lot of businesses that are structured for yesterday that are good ideas, but will be better served if they just call it early and then reconstitute that business later under a new debt structure. And I mean by debt structure, meaning rent and employee and wages and inventory. Because I think just like with real estate, yesterday's prices means nothing for tomorrow. And there are some businesses that should just call it a day and reconstitute it next year. So
Yeah.
really look at that. I think that's great advice, Greg. So thank you very much for being our expert on Monday.
Yeah, man, I enjoyed it. Thanks for having me.
You got it.